Welcome back. Now here we're going to solve another cost of capital budgeting. Cost of capital problem, and we have to calculate the WACC. Now, what is WACC? It is weighted average cost of capital denoted by K subscript O, KO. Now, let's look at this problem. A Limited gives you the following data. EBIT is 40 lakhs, tax rate 35%, 10% debentures 20 lakhs, equity capital rupees 10 each. Now this is the price per share, and 60 lakhs, cost of equity 15%. All earnings are paid out as dividend and debt is irredeemable. Calculate the EPS and calculate WACC. The company can increase its debt by 80 lakhs to a total of 1 crore, that is 10 million, using the amount to buy back and retire some of its shares at the current price. Its interest rate on the new debt will be 12%. It will have to refund the old debt. Its cost of equity will rise to 17%. EBIT will remain the same. Would you advise the company to change its capital structure? So, first of all, we'll have to find out what is EPS, earnings per share, and we have to calculate the weighted average cost of capital. So let's do it. So how will you find out EPS? All right, now EBIT is given, earnings before interest and taxes. Now EBIT is also PBIT, profit before interest and tax. All right, that is 40 lakhs. Out of that, you deduct interest. The interest amount. What is the interest? Interest on debentures. So 10% on 20 lakhs, that is 2 lakhs. So 10% on 20 lakhs is 2 lakhs. All right. Then you have EBT, earnings before tax, or PBT, profit before tax. So we are left with 38 lakhs. All right. Minus tax. Now what is the tax rate? Is it given? Yes, tax rate is 35%. So at 35%. So at 35%. So 35% of 38 lakhs is 13 lakhs 30,000. 13 lakhs 30,000. So we are left with EAT, earnings after tax, or PAT, profit after tax. So which is 24 lakhs 70,000. All right, minus preference dividend. Is there any preference dividend in this problem? Well, we can see that there's no preference dividend. So dash, nil. So finally we are left with equity earnings. Right, equity earnings is nothing but earnings available to equity shareholders, which is 24 lakhs 70,000. Now we're supposed to find out EPS, earnings per share. Now EPS is nothing but equity earnings, earnings per share, equity earnings divided by the number of outstanding equity shares. All right. Now we have already found out what is equity earnings, 24 lakhs 70,000. Now what is the number of outstanding equity shares? Now you look here, your equity capital is 60 lakhs and the price of each share is 10 rupees. So therefore the number of equity shares is 60 lakhs divided by 10, which is 6 lakhs. So therefore EPS is what? 24 lakhs 70,000 divided by 6 lakhs, it is rupees 4.12. All right, so 4.12. Now let us compute the WACC. Number 2, WACC B. Okay, computation of weighted average cost of capital, K subscript or WACC. All right, WACC. So you show the source of funds. All right, show the amount, show the after tax cost. Remember, when we find out cost of capital, cost of debt, cost of preference capital, cost of equity, we should always find the after tax cost. All right, and the total cost. So what is the source? The source is, you have two sources here. One is debenture, the other one is equity. There is no cost of equity is already given. See, directly we don't have to find out cost of equity. All right, and cost of debt, do we have to find out the cost of debt? Yes, we have to find out the cost of debt. What is the cost of debt? All right, now the cost of debt is, let's do it here. KD, cost of debenture. KD is interest into 1 minus tax rate. So the interest is 10%. All right, it's given here. You see, 10% debentures. All right, so 10% into 1 minus tax. What is the tax rate? Which is given 0.35, 35%. Okay, so therefore the tax rate, your KD, will be 6.5%. All right, so the source is equity capital, and debenture. Debenture is also debt. What is the amount? Equity capital is given. Equity capital is 60 lakhs. Debenture is 20 lakhs. So 60 and 20. 60 lakhs and 20 lakhs. All right. Take the total of this. This will be 80 lakhs. What is the after tax cost? Now the cost of equity, KE, is given. All right. So cost of equity is 15%, and cost of debt, cost of debenture, which is found out, 6.5%. So take 15% of 60 lakhs, that is 9 lakhs. 6.5% of 20 lakhs is 1 lakh 30. Add that up, it'll come to 10 lakhs 30. All right, so therefore WACC KO is equal to 10 lakhs 30,000 divided by 80 lakhs into 100. Now if you calculate, it'll come to 12.88%. All right, now we have computed the EPS, earnings per share. We've also calculated the WACC. Now let's look at the third part of the problem. Let's read that again. The company can increase its debt, all right, by 80 lakhs to a total of 1 crore or 10 million, using this amount to buy back and retire some of its shares at the current price. Its interest rate on the new debt will be 12%. It will have to refund the old debt. So it has to redeem back the old debt, that is debenture. Its cost of equity will rise to 17%. EBIT will remain the same. Would you advise the company to change its capital structure? Now let us find out whether it is advisable or not to change its capital structure. All right. Now look here. Now see, the company has to raise a new debt. Okay, its interest rate on the new debt. It has to raise new debt at the rate of 12% interest for rupees 1 crore. And use the proceeds. So it's going to take a new loan and it's going to use that loan as follows. All right, number one, it's going to repay existing 10% debentures, okay, of rupees 20 lakhs. See, it says here, okay, it will have to refund the old debt. So it's going to repay the existing 10%, okay, debentures of rupees 10 lakhs. All right, 20 lakhs. This 20 lakhs it have to repay back. Redeem, in other words, has to redeem. And the number two is, okay, now, so it's going to use 1 crore to repay back 20 lakhs, to redeem back 20 lakhs. So what is the remaining amount? 80 lakhs, yes. So what is it going to do with the 80 lakhs? It is, it is buy back, it'll use that 80 lakhs to buy back and retire some of its shares at the current price, all right, at the current price, okay. Now, we will find out. So, the balance rupees 80 lakhs will be used to buy back the equity shares at what is the market price per share? Now we have to find out what is the market price per share. All right, the existing market price per share. Let us find out the existing market price per share. So the existing market price per share will be computed as, all right, now we know what is KE, it's given, right, 15%. Now we know what is EPS. Remember, we've already found out EPS, 4.12. All right, now we have to find out what is market price per share into 100. Now what is KE? KE is 15%. Remember, it's given. See, cost of equity 15%, equal to EPS, which is 4.12, and the market price per share. Okay, so therefore we calculate market price per share will be equal to rupees 27.47. All right, so that is the existing market price per share. So it'll buy back the equity shares at the market price per share, existing market price per share of rupees 27.47. All right, now how many shares is it can buy back? So number of equity shares is equal to 80 lakhs. So remember, the remaining 80 lakhs you'll use to buy back some of the shares, okay, at the rate of 27.47. So you'll be able to buy back 2,91,227. So now what is the remaining equity shares outstanding? Now, you remember The existing number of equity shares is what? Is 60 lakhs divided by 10. So there are 6 lakhs equity shares. Now you're going to buy back, you're going to redeem some of the equity shares. All right. Now how many equity shares you're going to redeem? 2 lakhs 91,227 shares. So the remaining equity shares will be equal to what? Equal to 6 lakhs minus the number of equity shares you're going to redeem. So now you are left with 3 lakhs 8,773 equity shares. All right. Now find out EBIT. Now EBIT will remain the same. Okay, 40 lakhs. Wait, made a mistake. 40 lakhs. All right, minus interest. Now what is this interest? Okay, this interest is nothing but the 12% of the new loan of 1 crore. All right, so this interest is 12 lakhs. All right, so we are left with 28 lakhs. 28 lakhs is your EBT or PBT minus tax. Tax rate will remain the same at 35%. At 35%. So that is 9 lakhs 80,000. 35% of 28 lakhs. All right. So your equity earnings. Now, why equity earnings and not EAT? Because there's no preference dividend. So this will be equity earnings. So equity earnings will be 18 lakhs 20,000. All right. So find out your EPS now. So EPS is equal to equity earnings divided by the number of equity shares. So what is equity earnings? 18 lakhs 20,000 divided by number of equity shares. Now what is the number of equity shares? The remaining equity shares outstanding is no longer 6 lakhs, it's only 3 lakhs 8,773, which equals to rupees 5.89. All right. Now let's find out KE, cost of equity, using the earnings price approach. EPS divided by market price per share. All right, into 100. Now what is the new KE? It's already given here in the problem. See, it will have to refund the old debt. Its cost of equity will rise to 17%. The existing was 15%. Now because you have taken a loan of 1 crore, that cost of equity will rise to 17%. So KE will be 17% equal to EPS, which you already found out, 5.89. 5.89. Market price per share we don't know. You have to find out. So market price per share is equal to, if you calculate, it'll come to, so it is 34.65, the market price per share. All right. Now the question is, would you advise the company to change its capital structure? Now, you will advise the company to change its capital structure when two things happen. When the EPS increases under the new capital structure, the earnings per share, And when the market price per share also increases under the new capital structure, then only you will change its capital structure. Now, what was the old EPS? The old OPS was 4.12, right? And the new EPS is 5.89. So there, the EPS itself has increased. So there itself you have a point. You have a reason to change the capital structure. And another thing is, you'll notice that the market price, see the current market price per share is 27.47. Under the new capital structure, the market price per share also has increased 34.65. So therefore, since the EPS and the market price per share are more than the existing or the old values, the company should adopt the new capital structure. All right. So because since the, again I'll repeat, since the EPS, the earnings per share along with the market price per share, they are both greater than the EPS and the MPS of the existing, of the old capital structure, the company should adopt. In other words, the company should take a loan of 1 crore, okay, redeem the old capital structure, all right, sorry, redeem the old, the old debt, and use that money to also retire some of the shares. All right. So with that, we are done. I know it is a long problem, it is tedious, but please go through it. It is important, very, very important. All right. Thank you.